Good afternoon, everybody, and welcome to our webinar this afternoon, Common Accounting Mistakes AE Firms Make, and what are they and how are they avoided? So your presenters today will be Brad Wilson and Lisa Lee. And just a few housekeeping items before I turn it over to them to take you through this next half hour. You can customize what you're seeing on the screen right now by going to your GoToWebinar screen viewer. And if you are having any audio issues, hopefully you're not, hopefully you're hearing us loud and clear this afternoon, you can toggle back and forth between the computer audio option and the phone call option with the number that was provided to you during registration. And if you have any questions throughout the presentation, please drop them into the questions panel as we do not monitor the chat box. There is a handout available for download, which is the presentation you will be seeing this afternoon. And there are a few polling questions in here. However, we are not offering CPE for this webinar this afternoon. And as always, there is a survey at the end of this presentation to let us know how we did. And additionally, if you have any questions and they don't get answered or they pop into your head after the presentation today, just drop them in the survey and we will have our presenters reach out to you. So without further ado, Brad, you can take it away.
Thanks a lot, Kaylee. Thank you everyone for joining us this afternoon. Lisa and I are starting a series here of 3 webinars, 1 a month for the next 3 months, about common accounting mistakes and improvement of your use of accounting data. Of course, we cannot address every accounting mistake that we have ever seen, or let's call it operational issues in 30 minutes. But we want to start today with the foundational issues, the things that are kind of, let's call them table stakes, that you need to have this stuff kind of figured out or everything else downstream could be a potential problem. And again, it's only a 30-minute presentation, so we're really talking kind of high level. We're not going to get into a lot of detail until webinar number 2 and 3. But again, the concepts that you'll hear today, the issues that we're going to raise today will be built upon foundational again to webinars 2 and 3 coming up in October, November. So let's start with some introductions. Why do Lisa and I think we can talk with authority about this subject? Again, my name is Brad Wilson. I've been a consultant in the AE industry for almost 30 years now. Well, consulting for probably the last 20, but prior to that, 10 actually in firms as controller, CFO, and eventually an owner. Did some work with PSMJ for many years. Recently joined, well, it's almost been a year now with Stanbaugh Ness. And I work in the AE advisory group, which is, we don't do the accounting part directly, but we're very dependent on the firms that we do work with having good accounting data to provide us for various types of accounting, valuation, mergers and acquisitions, ownership transition. All of that stuff is very dependent upon good accounting data and efficient operations in your financial management. So we take a special interest in making sure that firms have got this part of their business taken. I'm a finance guy by training, certified management accountant, not public accountant, but that means I'm very focused on the application of your accounting talents, your accounting skills, in addition to the technical side. I'm joined by Lisa Lee, as Kaylee said, and Lisa, I'll let you introduce yourself, please.
Okay. Hello, I'm Lisa Lee. I'm the Director of Client Accounting Services here at Stanbaugh Ness. I lead a team of 6 accountants, and what we do is we collaborate with mostly small architectural and engineering firms to provide support and strengthen critical accounting operations within their firms. Prior to working at Stanbaugh Ness with the Client Accounting Services team, I was a controller at a mid-sized engineering firm here in South Central Pennsylvania for a few years. So, like Brad mentioned, have experience working in accounting offices under using these different things that we're going to talk about today, running across the issues, whatever, with working to resolve those as well.
Great, thanks, Lisa. And you'll find that with a lot of people at Stanbaugh Ness. Not sure how familiar all of you are with our firm, but especially in the group of us that work directly with AE firms, there is a lot of hands-on experience. So, there are a lot of consultants out there who will talk conceptually about what you should be doing inside your firm, and you know that that's physically impossible in some cases. Lisa and I can clearly say, been there, done that, made the mistakes, got the t-shirt. Hopefully we can educate you all, provide some of our learning from our past experience and our current experience with AE firms in helping you work a little better through the financial management and actual physical accounting functions in your company. So going to jump into the learning objectives. As I said, common accounting mistakes, foundational accounting mistakes is the point of this webinar. And we should say mistakes are maybe a misnomer here a little bit. It's not necessarily we're going to focus on stuff that is wrong as much as it is things that are just not the way they should be. Again, it's a subjective assessment to some degree. Well, one of them we'll get to right away in the first set of bullets here is to talk about cash versus accrual accounting standards. Lisa's going to explain a little bit more about that when we get into the nuts and bolts of this, but at a high level, cash basis is not wrong, so we can't say it's a mistake, but it's not right for performance tracking, and we'll explain how. Delayed processing of invoices and monthly reporting. Okay, accounting has the built-in flaw of being rearward looking, right? We produce a financial statement, maybe what is it, the 14th right now, maybe you're getting August wrapped up, I hope. If you're just getting June wrapped up, then you're in the right place. We're talking right to you about delayed processing of invoices and monthly reporting. And then again, not wrong or mistakes, just not done correctly for AE firms is the separation of net revenues and gross revenues and direct labor and indirect labor in your general ledger. You'll see, well, in the following webinars, honestly, why so many of our metrics are crucially dependent on separating out direct labor from your overall payroll cost. And again, we'll focus a little bit on those of you that are QuickBooks users. QuickBooks does not separate that out by nature. It's got a general ledger account called payroll, and it all goes in there. And that basically means you can't calculate metrics without Excel and some other outside the system software. So again, more detail on that here as we go through the presentation. No system for tracking sales versus revenue to measure backlog. This is a personal pet peeve of mine. Everyone realizes, I think, or you should realize, that the challenge with operating an AE firm today is not necessarily marketing. It can be, but the staffing, the manpower piece is a big challenge. Recruitment, retention, not knowing exactly how much runway you still have left on your projects and when you need to start marketing again, and putting your staff on the roller coaster of being way too busy and then having nothing to do and repeat that every month or so is bad for retention. And so the challenges with that can be addressed if you track your budgets, track your sales separate from your revenue, and we'll go into a little bit of that too. And then this one's a little tongue-in-cheek because some of you might be on the call right now, but inexperienced staff and owners trying to do too much for multiple reasons, trying to hold down costs, just your attitude about the way that you think about accounting can be a contributor to this. But if you recognize inexperienced staff or owners trying to do too much can also mean delayed processing of invoices and monthly reporting, and no tracking of sales versus revenue because you don't have a sales tracking system. You don't have time to do that. So that one can build on others, but we found that, I think, in our shared experience in the AE industry as one of the first very, let's call it, foundational issues with downstream accounting problems, downstream processing problems. So that brings us, we'd like to know this, who we're talking to, so we can customize our message a little bit the rest of the afternoon here, or the rest of the 30 minutes, with our first polling question. So Kaylee's going to open up a poll, and we need to know, would like to know, who's currently doing your accounting work in your firm? You know, is it the owners? Is it a relative of an owner? Is it the outside CPA firm? Do you have on-staff admin bookkeeper, which would mean no formal accounting education, but learning by seat of the pants, let's call it learning by example, learning on the job, or an on-staff accountant where there's an actual accounting degree and some understanding of the way things are supposed to be technically. Still may or may not be AE specific enough, but we just like to know a little bit about the audience we're talking to so we can talk about the right thing. So please take a few minutes if you would and fill out the poll.
Yeah, Brad, and it looks like about 90%, oh, there's 94% of the crowd has already voted. So I'm gonna go ahead and close and share the results and so everybody can see who's on the call with them and give you a little preview as to who you're talking to.
Great.
So closing and sharing. So it looks like 55% say they have an on-staff accountant. 23% say they do have that on-staff admin bookkeeper. That's kind of flying by the seam of their pants. 16% say they do have an outside CPA firm doing their work. 3% say a relative, and 3% say the owners.
Well, I would say that's very positive outlook. That's much better than I expected and gives us a lot of leeway to be able to talk in a little more detail about some of the problems that's related here, because more than half of you have an on-staff accountant, or you might be the on-staff accountant. So a lot of this information that Lisa and I are going to share this afternoon is going to be very relevant, and you'll have a point of reference for some of the things that we're going to discuss. So very happy with the outcome of that first poll. So thank you for answering there. One more issue, and I think that it is foundational before we get into the weeds here, is a lot of AE firms, at least in our experience, look at accounting as an overhead expense. And, you know, technically it is. You know, are you looking for, you know, the bare minimum, you know, to stay compliant with payroll and get
Brad, I believe you're muted or we're not hearing you.
All right, I'm trying to get his sound back here.
Can you hear me, Kaylee?
Yes, I can hear you.
Okay, I was gonna say I can continue if.
All righty, it looks like he is logging off and probably logging back on. So Lisa, did you want to cover for him for a few minutes till we get him back up here?
Yeah, sure. I can continue on. So I believe he was saying on this slide, you know, are you looking for the bare minimum just to do what has to be done, you know, in order to meet all the requirements with payroll, the income tax, things like that? Are you actually looking for financial data that you can use to analyze your firm moving forward? Oh, you know what, Kaylee, I can't move the slide forward.
All righty, let me pull up the slide here and take the presentation rights from him. All righty, getting this up here for everybody. All right, let me know when you can see my screen, Lisa.
Yep, I can see it.
Alrighty. So we were here.
Mhm.
Alrighty. And let me pop this back in and get it back up for everybody. Alrighty.
Okay. So, well, I need to tell you to advance it. I'm sorry.
Yeah.
Okay, go ahead to the next slide then. So the question becomes, do we need to invest in a real accounting person? And like Brad mentioned, or when we saw in the poll results, a lot of you already do have that person on staff. So, just people who don't, maybe a few pros and cons of having that. It does free up time for if an owner or one other professional on your staff is doing, performing those tasks now. If you do have a dedicated accounting person or somebody that really knows, the processes and can take that on, it does release the owners or the professionals, from having to do those tasks. So every hour that they don't have to spend doing those accounting type things, they, have more hours that can be billed to projects, which increases, your staff utilization, and it also increases then the revenue because you have more billable dollars. Also having a dedicated accounting person on staff, and if they are, a knowledgeable accountant, it does create more timely and efficient processes, including your billing process, which again will, increase your cash flow. Go ahead, Kaylee. And actually this was back on the other slide, I'm sorry. I'm trying to fill in here, but so if you're looking at the cons of it also, there is a cost involved, and some people would say when you're weighing it to the benefits, it really isn't a significant cost because of those things we just mentioned, as far as speeding up the cash flow, having more billable hours, which in turn increases your revenue, and those kinds of things. And obviously you can't remove an owner completely, and you wouldn't want to remove them from the financial management. But when that person or that owner or that other professional is spending all the time in the weeds trying to figure out, what's going on at a lower level in the accounting world, again, they don't have that time to focus on the tasks that would provide a much greater benefit to the company. Okay, next slide, sorry. So we'll just review a couple common accounting terms that are project related. And this first one here, we're actually looking at the chart of accounts. So most of you, I'm sure, already know that your chart of accounts organizes and categorizes your income and expenses. And in the A&E space, or the architecture and engineering space, or project related accounting, we do somewhat have a unique chart of accounts. Here on this slide, you can see there are a few mentioned. Work in process, which is also sometimes called unbilled revenue, which is your unbilled labor, or sometimes sub-consultant expenses, or something that you have not been able to bill your client for yet. So that is your work in process, which many firms, especially smaller firms, don't value that work in process on their financials. And that's something we'll talk a little bit more about when we get into the accrual-based accounting. Also such things as your accrued payroll, prepaid expenses. When you pay your professional liability insurance, do you post that expense all in 1 month? Again, then you're seeing a great expense only at certain periods throughout the year instead of accruing that cost and spreading it out. Customer deposits, if you're receiving cash prior to performing the work, it looks like you're recording revenue before you've actually earned it. So again, something that is on a balance sheet for for project related accounting that may be unique. Looking at your income statement, Brad had mentioned gross and net fees, direct and indirect labor, classifying those separately. As he mentioned, that's very important. It's very important if you're tracking any allowable FAR type overhead that you have to be tracking for those purposes. And also by looking at the income statement and classifying it separately, looking at your overhead expenses, you can compare those. You can use those overhead costs to figure out how much you need to charge on top of your, your labor expense, your direct labor expense. So by classifying your accounts correctly, it will give you the ability to do that. Next. So here's just a quick example of your balance sheet and your income statement, just, a numbering system that is very architectural engineering project related. By keeping your accounts in this type of order, it will allow you to track the things that you need to track as far as looking at your net revenue, looking at your gross revenue, your direct labor, direct project expenses. By keeping all your indirect costs separate, you do have that overhead factor then that you can look at. The other thing that you would want to do by keeping your direct and indirect labor separately is you can look at your utilization. How billable are my employees? Are they, at the average percentage, or how do they compare to, other firms of our size and our same niche, or whatever, whatever your firm is focusing on. And also by keeping your direct labor separate, you can track your net labor multiplier. What is the markup? How much are we able to bill our revenue on top of our costs? Next one. Okay, so talking about cash and accrual basis accounting a little bit. Hopefully Brad will be able to log back on. He has an example in a few slides that kind of gives you a real world example of the difference between cash and accrual. But accrual basis accounting recognizes the revenue when it's earned and the expenses when it's incurred. As in contrast to cash basis accounting, which focuses on pretty much on cash in, cash out. If I pay it this day and I get money in this month, that's how your cash basis is pretty much is tracked. And most AE firms are cash basis for tax purposes, and that's what a lot of firms do focus on. But it doesn't offer you an accurate portrayal of your firm's financial health near as much if you're looking at it cash basis as if you're looking at it accrual basis. So looking at a cash basis, it is easy to calculate. You can pretty much look at your bank statement and you can tell, how much money did I get in, how much money did I spend. So it does allow you, to easily calculate that performance. You can be timely with it because, on the last day of the month when you write the check or you put the deposit in the bank, that's the ending right there. You can create your financial statements or whatever you're looking at as far as the analysis of that. It also is not, if you have mostly time and material projects, cash basis does work better for those types of firms than firms with long-term or fixed fee or milestone billings. One reason that would be is because whenever you're looking for your long-term projects or your milestone billings, you may be working 2-3 months ahead of time before you are actually going to be able to bill that contract. So you're incurring all that labor cost for 2-3 months. So the cost is going in separate financial periods than your revenue, which won't be recognized until maybe December. So all along those couple months, it looks like you're losing money, and then all of a sudden here, you are recording it on your books. So as an owner of a small firm, you probably have that in your head and that's coming, but it still doesn't give you the ability to analyze your financial information based on a financial period, such as a month or a quarter, however you're looking at that. Okay, next slide. So the next one here is just on the accrual basis. Again, this kind of all relates, advantages and disadvantages of each is the opposite of the other, obviously. But another advantage of your accrual basis is that you can look at your cash flow a lot better. You can look at your accounts receivable, how much have I billed, and looking at your average days in accounts receivable, you can kind of predict how much money is going to be coming in, at each of the months. So it gives you a lot better predictability that way. You can better plan your resources. Do I have enough staffing? Looking at, and that's kind of what Brad was referring to as backlog. By keeping all that information on an accrual basis, you get a better idea of what staffing you might need. And again, it recognizes the revenue and earned and the expenses incurred in the same period, so that you can actually analyze how much did I spend on this project and how much could I bill on this project. And you don't have to look over multiple months, or you don't have to remember that, oh, I'm going to bill that in 3 months, or sometimes it even works the opposite. You think you're making a lot of money on a project, and then all of a sudden you get a sub-consultant invoice that you didn't expect to come in, or you forgot. I shouldn't say you didn't expect, but maybe you forgot that they hadn't billed all of that yet. And then all of a sudden it throws your projects into a loss when all along you thought you had plenty of budget left. One of the disadvantages to the accrual based is it does take additional time to close and calculate because you are waiting maybe for, you know, the few extra expenses to come in for the prior month. It does take somebody at a little bit of a higher level of accounting skills, just because you need to see the big picture more and understand how, you know, all of that relates together. One disadvantage, and I don't really think it's a huge disadvantage, but because you are recording the revenue as you're billing it, you may not be collecting it all. We always know we have invoices that, you know, are going to go to bad debt or whatever, but always that should be, you know, offset with an allowance for bad debt account or something like that if you're doing your accrual basis accounting. So Kaylee, did we get Brad back yet?
I think I'm here. Can you guys hear me?
Okay, I can. You're just in time.
All right, outstanding. Gosh, everyone, I apologize for that interruption. I just lost my internet completely. It went down and I was amazing. So 20 years of presenting and that has never happened. So now I have a first to say on September 14th, 21, I lost the entire crowd. So to pick up on what Lisa was just explaining, cash versus accrual can be a problem at the high level. But if you're cash basis, it also has a very big problem with the project level. Kaylee, if you could go to the next slide, we'll show you what we mean here. Our next webinar coming up in October is about the ins and outs of project accounting for small firms. And of course, a cash basis accounting system puts you on the wrong foot to begin with. And here's an example. So this is a phased fixed fee for project. Full service AE design, $1 million fee. You can see all of the costs associated. That adds up to a $200,000 expected profit, or 20%. The payment terms that were negotiated are 75% at the construction documents and 25% of the fee at the end of the third year when the construction is done. So if you look at the illustration of cash on the next slide, you can see that the long-term contract assessment of profitability is all over the place. Year one would look like a $175,000 loss because you had to complete a whole lot of the work and got no billing. Okay, so on a cash basis, that's a $175,000 loss based on the planned expenses, and your assets and equity dropped by $175,000 because you put the money out and you got nothing in, no revenue on a cash basis at all. You haven't been able to send any bills. Then the revenue jumps, of course, because you get to bill 75% of the project, which actually exceeds the degree to which you're finished in year two, and you make 47%. You go, wow, we went from really terrible to really good in about 1 year. Now, does that make sense? Probably not, because we're on the cash basis. Then you get to year three and you get to invoice your last 25%. That roughly starts to match up a little bit because everything has to, all those data points converge at the end of the project. So you actually do still end up making the $200,000. You just don't know when or how or what phase or what part of the contract turned out to be the most profitable, because you've got a big loss, a big win, and then a 10% profit that all adds up to 20. And if you're not happy with that, really no track record to be able to track back to see where your mistakes or your challenges were. So if we flip over to the accrual basis, which is the next one, you'll see that things now level out very nicely because we're tracking revenue on an accrual basis. On a long-term contract, this revenue needs to be tracked as you earn it, as you do the work, regardless of when your billings. This is the definition of accrual-based accounting. And you can see that it very nicely represents, kind of smooths out your net revenues and your profit percentage. And again, this, from an accrual basis, this is not cooking the books. And of course, this is an illustration because it's nice and smooth. We don't see projects making 20% every month in and out. But the crucial aspect of it is it matches the effort and the expense to the revenue in the same time frame. And that is the foundational aspect of accrual basis accounting for projects. Okay, so if we move on to QuickBooks discussion. QuickBooks can be set up on the cash or accrual basis, and you can throw a switch and jump back and forth from both of them. QuickBooks, why are we putting QuickBooks in this? Because a lot of small AE firms believe in QuickBooks, use QuickBooks. It's the most popular software out there, and there's nothing wrong with it. It just doesn't do all of the things that AE firms need it to do. And it fools you because, again, part of the cash accrual system is the way in which you look at your contracts and allocate your costs and revenue in time frame, not just throwing a switch and saying, I want to look at my income statement on an accrual basis or a cash basis, as QuickBooks will let you do. Okay. If we go on to the next one, please. The reason why it works great is it's simple, easy to learn. Those of you that have bookkeepers or even owners or relatives of owners doing your reporting, doing your accounting, QuickBooks is a great place to start. The accounting basics of payables, receivables, bank reconciliations. There's no issues with using QuickBooks and not having the data you need to do your tax returns and know how much money you've got in the bank, right? But it comes with some drawbacks, of course, as you probably know. On the next slide, we'll talk about the lack of detailed project functionality. Again, we'll go into a lot more detail on that next webinar, but there's an AE specific chart of accounts. You probably saw that while Lisa was talking and I was struggling with my internet connection. We have to separate direct and indirect costs, as Lisa discussed. On the third webinar, we'll talk about the key metrics that are necessary that are derived from the first two, the special chart of accounts and direct and indirect. Flexible and detailed invoicing. We know we have some demanding clients in the AE industry who want to see their invoices in a very specific format. Sometimes QuickBooks can help you out on that. Many times it takes an aftermarket software bolt-on or some supplemental software to be able to get the flexibility into your invoicing. And then of course you really have to dig. There's no QuickBooks AE version, so we really have to dig out the data in order to do performance metrics, the KPIs, key performance indicators for the AE industry that we will talk about in webinar number 3. So on the next slide, we really get into my pet peeve. And again, I know we're running short on time because of my mistake here, so we will not talk a whole lot about this, but crucially important in your accounting software is to know how busy your people are and how long they are going to stay busy so that you can plan your amount of your marketing efforts, your staffing levels, and it translates into retention and employee happiness and just general degree of stress in your office all the time, from I've got way too much to do or way too little to do. And that sounds like a production issue, productivity, operations, but accounting has a key role to play there because budgeting your time and tracking the amount of future effort that has been paid for in each contract is crucially important to project the amount of, as I said earlier, runway that you have left to be able to keep your people busy. If we switch to the next slide, I'll talk to you about some of the benefits of tracking backlog. And most firms do this. The firms that do this do it outside the accounting system in an Excel spreadsheet. But that's double data entry, and most of the better accounting packages used in the AE industry have the opportunity to book your full budget inside the project so that you can take the total amount of revenue that's in the contract minus the amount of billings that have been done so far or earnings on the accrual basis, as we've talked about, and then spread the remaining budget out over time. How many people will that keep busy at your hourly rate, average hourly rate, or their specific hourly rates for how long? So that you can communicate to your staff and communicate to your clients exactly when the next job can start and when you need that next job to start so that everybody maintains their utilization. Now, I said a key word in that whole explanation of a project specific, a project friendly, let's call it, accounting package. So that brings us to the next polling question, which is, what are you currently using? First two bullets there, Vision and Agera, are industry specific. QuickBooks alone has been out there for a long time, as I mentioned. QuickBooks plus any number of add-ons is very common out there, and add-ons from time tracking to budgeting to resource planning. There's hundreds of them if you go on the QuickBooks Marketplace, or something else that we didn't mention. We're interested just to see where you stand so that when we talk about projects next month and you log back on, we've got a little better point of reference to know what kind of information you're already getting from your system. So if you please fill that out, or maybe you already have.
Yeah, Brad, it looks like 91% has already voted. So I'll give you another second or two, and then I'll go ahead and close and share the results. I do see that there's quite a bit other answered. We have about 19% of the crowd. So if you would drop that into the survey, we'd love to see what platform you're using to be kind of nosy and curious.
There's others a big category, but the AE industry generally suffers from not enough choices for software. There's the Deltek monster that maintains a lot of the software, and then there's QuickBooks, which is the most popular, but as we've talked about, not good enough all by itself for an AE firm. But other being the second largest category in our poll, we'd like to hear from you as to just exactly, maybe put that in the comments, just exactly what kind of software you're using. So that we're 6 minutes over, and I know those last 10 minutes were pretty rushed because of my internet issues. I will make sure that that does not happen if you come back and visit with us again in October. But if you've got questions, be sure to reach out to us. We've got the poll at the end about how we've done. And of course, we know we're going to get low ratings for internet connectivity, so we'll just take that already. But we hope the content was useful today, and we really encourage you. This was the foundational first webinar. Number 2 and number 3 go into more detail, but build on the information here. We're really looking at it as a package of 3. And I think the dates are on our next slide. If you log on and actually attend the October 12th and the November 9th, then Stanbaugh-Ness is offering you, anybody who does that, some free consulting time, some free discussion about how you're doing things, how you might improve them. If you want us to go hands-on and actually help you do that, we'll send you a proposal. But the discussion about where you might want to head and some of the things that you might want to look at yourself is free of charge for anybody that actually attends all 3 webinars. So we hope you take advantage of that. Our contact information, feel free to reach out to us directly if you need to. But we really appreciate your time this afternoon. And it looks like most of you hung with us for the full 37 minutes as opposed to 30. So again, really appreciate that, and hope you have a great rest of your afternoon.